go get this webinar set up with my friend, Mr. Howard Chan, Kurv Investments, talking about a term that people have heard about, but maybe not that familiar with exactly how that term has come about and what it means for some of your clients if you're a wealth manager and advisor. By the way, if you're a wealth manager or advisor and you happen to be working like us and you're at the office, please do me a favor, tell other people in your office to join this webinar. It always helps to get this as full as possible, as much as possible in terms of the attendees. For those that are here for the CE credit, I will email you after this webinar. I'll get those submitted, want to get your information respectively. So stay tuned for that. And I do hope everybody's going to enjoy their July 4th week. I have been nonstop working, but that's just the entrepreneur's life, as I'm sure many of you can relate to. So folks, let's get started. For those who are not familiar, my name is Michael Guyed, publisher of Lead Lag Report, manager of Lead Lag Media, which is growing quite a bit as well, which I'll touch on for another webinar at some point. This is going to be a webinar sponsored by Kurv Investments, Howard Chan, who I've gotten over the last many months. He's got a number of interesting funds. And so let me talk about these 351 transfers, 351 exchanges, which have been a big buzz term, but really getting to the weeds as far as how that works. If any of you have questions during this webinar, just type it in the chat, type in the Q&A. I'll bring it up towards the end. But Howard, it is all yours, my friend.
Great. Thank you, Michael. And thank you, everyone, for joining us. Today, we want to go through something that has been going around, I think, for the last a year or so. And the reason has been, we've seen a tremendous rise in equity markets. And many people have held their securities for a long time and they have very low basis. And many people are trying to figure out ways in which they can manage that capital gains. And some of the existing solutions, such as exchange funds, have had capacity issues. So people are looking at alternative ways. And this has been popping up as an alternative way to manage that capital gains. And I'll go in detail about how this works and then what's the compare and contrast to a traditional exchange fund. Just maybe a little bit of introduction of Kurv Investment Management. We are an investment manager. Our goal is to provide access to tax-efficient institutional-grade strategies and solutions. And 351 is the solution part of this mission statement. We have our team who formerly worked at most of us came from PIMCO and previously Goldman and some larger firms. And we came together because we saw that there were a lot of institutional strategies that really were not available to advisors and their clients. So our goal was to wrap those into an ETF vehicle so that it is accessible. But one of the things that we had to deal with was when we ran these portfolios, these strategies for sovereign wealth funds, endowments, and pension funds, they're non-taxable clients. So now you have it in a wrapper where taxable investors have access to it. We do have to actually think really hard about the tax component. And we've built essentially tax efficiency in every one of our strategies. And we're not just talking about tax loss. Tax loss generally is sort of the afterwards. You have a loss. How do you harvest that loss? We've built actually tax efficiency in the gains of the portfolio. So, if you're interested, please, reach out. We're happy to talk about it. But really what we're trying to do is we're using some alternative strategies using derivatives to generate both total return and income. And what we want to do is to provide an asymmetric return profile. So magnify the upside and minimize downside. And then we want to really the gains that we've generated, we want to be able to be as tax efficient as possible. And obviously, as the goal of any investment manager is to give you risk adjusted outperformance. So per unit risk that you get, we want to give you more returns for that per unit risk. So we try to solve really three problems that I think many people face in today's environment, which is how do you get growth in your portfolio? And usually, when you have growth, you have to sacrifice income. And usually when you want growth, income, you sacrifice growth. So how do you have that both and potentially not as big of a trade-off on these two levers? And then while doing both with a very risk-controlled, risk-balanced approach, so you don't, use up all of your risk budget in your portfolio. we have essentially strategies and solutions. The strategies, we have two suite of products, the yield premium ETFs and our tech titans ETFs, and then our solutions, which we'll cover today, which is the 351 exchange. And just to give you a quick flavor of what we do in our strategy is in the yield premium, what we try to do is generate tax efficient income on growth single name stocks. And most, as you know, growth stocks do not distribute dividends. So you have to pick either having growth in your portfolio or having income. So what we try to do here is to generate income that is tax efficient. Sometimes it's not immediately taxable. And then you still get the growth part from the underlying. And this typically has been used by advisors whose client is approaching retirement or are in retirement. And so they want to have steadiness of income in their portfolio, less so in price appreciation. The other side is the Tech Titans ETF, which is more focused on, I would say, people who are earlier in their investment journey. They want to have both growth and income, but probably total return, maximizing total return is the most important part. And so this is a basket of growth names that will actually provide what we mentioned, which is asymmetric upside. It will magnify when the risk is on in the market, and then it will mitigate downside when there's a risk-off environment. And we've just actually come through, all of you know, Liberation Day. And we've actually have now, a whole cycle in which we can discuss how this actually has performed. We're performing quite well. I think actually of all the ETFs that we look at, we are either ranked number 1 or number 2 in terms of total return. But I want to go to actually the topic of today's subject. So when people mention Section 351, this is actually a section of the IRS code. And I want to mention where this came from because this will kind of explain a little bit of how to do the exchange. This particular code was actually written in the 1910s and 20s. And the idea at that time was there were, a lot of entrepreneurs. The scenario was basically, let's say you started as an entrepreneur like Michael, and the original form of your company that's appropriate maybe is an LLC. But as your company has grown, maybe another legal entity form is more appropriate. Let's say a C Corp, right? And so oftentimes if you want to change it, you can change it, but that's sort of a corporate action. And that could be potentially a tax event, right? So what this code ended up being written was that you can contribute assets from one corporation to another corporation, meeting certain constraints, and that would defer any essentially capital gains in that transfer. And so this law, basically, this rule from the IRS has existed for quite a while. And so why is it now that it is more and more important? And I think, if you work in the wealth management world like we all do, you understand how being able to generate returns is not just about what your investment portfolio is doing, but also how you manage taxes, how you want to look at after tax return. One of the advisors that we work with, he jokes, but it's pretty true, is like sometimes what I can do more for my client is not necessarily the returns I generate in my portfolio, but is how much taxes I can help you manage or defer, right? And I think it's pretty topical, as we know that there's going to be a new tax bill that is going through Congress, right? Not quite there yet. Currently, the U.S. has about a 1.8 trillion deficit. It looks like in its current form, the tax bill will increase that deficit. So that means when the pendulum swings the other way, we have to either do one of two things, which is either cut costs or increase revenue or do both. And so, this is something that I think for us, we think will be a more and more important focus as we go down for the next 3 to 5 years. And I think it's here we just, we pick some of the higher tax states like, California, And you can see that by deferring taxes as long as possible, you're going to be able to compound the returns and assets in your portfolio as long as possible, as high as possible. And obviously, and I want to be clear is that none of these methods that we can't destroy tax liability, right? That's tax evasion. We don't want to do that, but we can be able to defer taxes as long as possible in order for this compounding effect to happen in the portfolio. So let me go into details now. So in a Section 351 exchange, you may have a series of individual names and stocks that are highly appreciated. So this is let's say in an SMA, or it could be an existing ETF, which is a security as well. And you can contribute that basket of securities into an ETF. An ETF itself is a registered investment company. So if satisfy the 351 exchange that you're contributing assets into a company, and the reason why this is especially suited for an ETF is because we have a market maker in between who can take assets from the client or the SMA and contribute that into the ETF. And they do this every day. We do this with the APs and the market makers. They give us securities to put into the ETF. We give them shares of the ETF that deposits into their account. So instead essentially, this is the trade flows that we do every day. Now, the party that's contributing assets into the fund is potentially that advisor who has a client that has a basket of highly appreciated securities. And what is the purpose, essentially? How can you actually use 351? And I think there's a couple of scenarios that we have actually worked through that is pretty, I think, common in these cases, which is, as an advisor, you have a client who has held, say, Apple or NVIDIA for 10, 20 years, and you couldn't really change the risk exposure of the portfolio, right? You can't, if you need to reduce, let's say, equity risk, increase duration, or decrease growth, increase value. In order to do that, you'll have to sell some of these securities, and that will realize a lot of gains. And that means that every time you try to modify the portfolio, your client's going to get essentially a tax bill, right? So one way in which people are using 351 is really it's unlocking the capital gains that's in the portfolio into a strategy that they're able to better manage the risk, right? And then third, the second thing is that you do need not just one security, and that's one of the big difference with exchange funds, which I'll go through. You do need a basket of securities, but they can be a very concentrated basket of securities. I think the least amount is about 13 securities. And then what you can do is contribute it into ETF that can further diversify that out into a broader market set, right? That maybe the original 13 is not as appropriate for the market environment that's going forward. So I've mentioned what are the benefits sort of as this 351 is you can obviously unlock securities that you couldn't really manage or align in terms of risk exposure. Something that is maybe not income generating, you can contribute it into ETF that uses the same security that generates income, and you could potentially move from essentially passive to active strategy that's in your portfolio. Obviously, one component of this is the tax efficiency, which is that the capital gains tax from the basket of securities that is transferred into the ETF, you keep those capital gains by lowering the basis of the ETFs that you receive. But then within the ETFs now, then you can modify the portfolio and gain different exposure that may have been ossified or locked into the original portfolio. And then the last thing is that in an ETF vehicle, as you know, that you have not only daily liquidity, but you have intraday liquidity. So this could potentially be very useful in terms of managing other tax liabilities, which I'll go through in a bit. So how do you actually what's the qualification process of having a 351 transfer? And there's three. The way we remember it is the 3Cs of 351. The first is a concentration test. So this is really, essentially, if you're aware of any mutual funds or ETFs, this is the RIC test, essentially. You need to meet a minimum certain diversification tests that the IRS requires. And the three tests here is concentration no more than 25% of a single issuer. So this is very different than an exchange fund. So you don't contribute one security. If you have an NVIDIA engineer that has a high concentration of NVIDIA stocks, the maximum of the NVIDIA position that they contribute is 25% of the basket. And then the remaining 75% of the basket needs to meet that any positions in that portion that's greater than 5% cannot exceed 50%. And if the math is a little bit complicated, we're obviously happy to help out. But the math comes out to essentially you have essentially minimum of 13 positions that you have to contribute. Now I'll go through a little bit. There's some wiggle room. I'll show you how that you can meet that diversification test. The second test is the control test, which means that members of the control group or the transfer needs to own at least 80% of the total share in a receiving company. Okay? So again, if we go back to the origin of the 351, this is essentially entrepreneur or owner who is trying to transfer assets from one company to another company. So in order to prove that they are the entrepreneur, they have to show that they have 80% of the total shares. And so this is typically then done when an ETF is fairly small or when an ETF is seeding a new ETF that's coming out into the market. And then the last test is the continuity test. And a continuity test is just basically saying, you have a company that sells furniture, you're changing the form of the company, you can't be transferring your assets into a new company and be selling fish or grocery, right? It needs to kind of do the same thing. So in the example of a 351 in this exchange format is essentially, it's very simple, which is that the asset you transferred has to be allowed by the prospectus of the ETF that is receiving that asset. So that's pretty straightforward. You can't, what this means is like, if you have an equity ETF, you can't transfer fixed income into it. You can't transfer commodity into an equity ETF, right? It has to be like to like asset. Now, if it's a balanced ETF in which it has both fixed income and equity, then you can transfer both fixed income and equity into that ETF, right? So the destination ETF is very important. So for example here, if you have a basket of technology stocks, it's not generating income, you can contribute that into, say, a cover call. There's lots of cover call technology stocks ETFs, right? So there, as I previously mentioned, the stocks are not generating income. You're contributing an ETF that can take technology stocks, and that strategy of the ETF can then also use calls or options to generate income that from a portion that was just kind of sitting and ossified in your portfolio. Okay, so the question then is, okay, I mentioned control group transfer. What does that mean? So when you do a 351 exchange, you actually, that 80% test needs to be met by a control group. And what that control group means is that it can be actually multiple contributors come together, constitutes as a control group. So, if you have, a small amount of assets, ETF is maybe already live, it's 5 million, you need to the end has to be 80% control. You can potentially, either through yourself or through a manager, combine your assets with other contributors then as a group, that group can contribute assets into the ETF, and it's that control group that has to meet the 80% control test. However, each individual contributor still needs to meet the diversification test and the continuity test. Okay, so let's give you an example. So I have a portfolio of my contribution basket. Let's go back to that NVIDIA engineer who has a highly appreciated in NVIDIA stock. And he has some bonds, right? So he wants to contribute both and he has stocks and bonds. So he's looking for a target strategy. And in this case, where there's stocks and bonds, he has to look for ETF that can take in both stocks and bonds. So a balanced fund is an appropriate ETF destination ETF. Now, I mentioned you have to have at least 13 positions because you have to meet that diversification test. So no issuers can be more than 25%. So in this case, we have 25% of NVIDIA stocks. So how do we actually come up with the other 12 stocks? You can actually, so part of this is you have look-through period. You have look-through. So you can actually take an SPY ETF that you have in the portfolio, which has 500 issuers, pair that up with an NVIDIA, and that actually will meet the diversification test. The other thing that is, if you know about the RIC diversification test, is that treasury bonds actually only count as the denominator, not the numerator. So that actually helps the diversification test. And the one thing to mention is that whatever your holding period is for each one of these actually holds as you transfer into new ETFs. So for instance, if the NVIDIA stocks you've only held it for less than 1 year, so all of the gains is short-term capital gains. When you contribute into ETF and you get shares of the ETF back, that quality will still be short-term capital gains. But if you have long-term capital gains and you contribute it, and the capital gains the basis that you get from the ETF will remain long-term capital gains, and the clock doesn't start. It just maintains the same quality of capital gains that you have. Okay, so what happens is, so now I have a contribution basket. I contribute the basket into the ETF, and I get the ETF shares back. I retain the cost basis. So for example, let's say my basket has $5 worth of capital gains, right? And let's say my portfolio is $10 and $5 of that is a capital gains. I contribute that basket into the ETF. I get shares of that ETF. It would be the shares of the ETF minus $5. So I keep the basis. I keep the quality of the basis, and I defer the taxes. And now the basket can be managed in the ETF. And so the question actually is, why would I do this, right? Because I still keep the gains. It's deferred. If I didn't sell it in my portfolio, it doesn't seem like there's a change. So what happens oftentimes is now you have a ETF that maybe is a broader exposure to the market, right? Say you have a concentration of NVIDIA stocks and now you're going to a balanced fund. And what happens with some people do is that in other parts of the portfolio, when they have losses, they can now do tax loss harvesting. They could crystallize the loss and sell shares of the ETF to net the gains in the ETF versus the loss in the portfolio, right? So this target ETF has to be something that is something you want to hold for a longer time, right? You reduce the concentration risk. It might be something that, US Ag with SPY. So, if you're betting still on the US economy, that's something you'll hold for the 10 years down the future. And then what happens is then you can do a layer of tax management where if you have losses in some parts of the portfolio, you can offset by the gains that you have in the ETF. And the last part to mention to crystallize the three constraints that I mentioned is that if you take a look here, you can do it with a live ETF that's already 5 million. The contribution basket has to meet that 80% test, which means that the contribution has to be at least 20 million. So 20 million out of a $25 million ETF is 80%. So then you satisfy that control test. How can you actually do it? And the way that we look at it is we use sort of a clothing analogy. There's three different paths to do it. The first is ready to wear. So you can contribute your assets into an existing ETF. Remember, you have to assume 80% control, which means that the ETF generally has to be smaller, right? So even here with the ETF of 5 million, your contribution has to be at least 20 million in order to meet that 80% test. So if the fund is already, at 100 million, that means that you have to, contribute 400 million into the ETF, which oftentimes the size, that's not a size that most people can do. But it is possible to do it with a live ETF. The more common way is to do it seeding a new ETF, an ETF that has a strategy that is in line with what you want in a portfolio. In which case, since there is no assets in a new ETF, any contribution satisfies that 80% control test. And that's probably the easiest way in which many different people who do 351 exchange, that's the path that they have gone down to. The last one, it is one that actually we thought this was fairly unlikely, but we've gone down this path actually, which is that if you have sufficient amount of assets, we can build a customized ETF to meet what your investment needs in your portfolio is. And that threshold typically is you want to contribute assets that's greater than 50 million or so. And so that the upside is you get a completely customized strategy that you have in an ETF. The downside is we have to file, so it takes at least 75 days for that to happen, right? Versus a new ETF that might be an ETF that's been filed, it's on the shelf, it's ready to be launched, and they just need to make sure the transfer happens, right? Same thing with an existing ETF. Is 351 the only option? And as I mentioned, obviously there's alternatives. And the common alternative is an exchange fund. And the way I want to compare and contrast is really not if one is better and one is worse. It's a set of trade-offs that you actually have to think about. And the way I think about it is 351, you have to do a little bit of work upfront to get actually some benefits through the transfer. Exchange funds, you don't have to do much work at all upfront, but there's some things that you have to essentially deal with if you do an exchange fund. Okay, so the first thing is the work upfront is obviously 351. You have to think about what that diversified basket of securities that you want to construct to contribute. Right. That sometimes is looking in the portfolio, meeting the diversification test, etc. Exchange funds are very simple. You have a stock, you want to contribute, you have to look at the exchange fund. The one constraint there is you need to find a exchange fund that is open to taking that particular stock, right? Because for those who are not as familiar with exchange funds, is they will take a bunch of stocks. The end goal is try to replicate an index like Russell 1000 or something like that, right? But Russell 1000 has only so much, say, NVIDIA in the index. So they can only take so much NVIDIA in the index. They have to take other things to construct the index. So there's a limit and capacity issue with an exchange fund. Now, for the work that you do upfront with 351, what the reward that you get is you get liquidity. Once it's in the ETF is not only daily liquid, is intraday liquid. So if you have some loss in some other part of the portfolio, you can, within a day or less than a day, you can actually manage that tax liability within your portfolio. Exchange fund, easy contribution, but you do have to typically has the typical standard lot is the 7-year lockup. Though if it has vintage, it can go down to 2 to 3 years, but there is a lockup period. So once you've contributed, you can't really take it out or manage it. You don't have access to it really for another 2 to 3 and up to 7 years, right? The target portfolio construction is, I would say, pretty equal for both parts. If you're contributing to an existing ETF or to seed a new ETF, typically those strategy has already been defined. And similarly, a lot of the exchange funds has already set the target that they have. The one way in which you have the most flexibility is obviously the bespoke path, where you do a custom ETF. That's obviously by its name, you have the most flexibility. But the strategies that you can have in these funds are a little bit different. By nature, ETF is a 40 Act fund. Most of them are 40 Act funds. So they have to have generally more liquid assets. Exchange funds, they have to have 20% illiquid assets in order to do the deferral of taxes and diversification that they have. And that 20% of illiquid assets generally takes the form of real estate. And that's that's just the construction of the fund. And then the last thing of the fee is the fee is usually the fee of the ETF. Some transfer process charge you for the transfer a bit, but most of the cost comes from the management fee of the ETF, and that can range from 50 basis points to 100 basis points. Exchange funds can be higher depending on where they are in the stage of the exchange and what the type of the liquid assets and strategies that they employ within the fund. So I do want to mention a couple of things that we do have coming up. One of the ETFs that we have, we're working towards actually doing a 351 is a portable alpha strategy. This is something that we filed quite a while ago. It is essentially S&P ETF. As many of you guys know, it's been written ad nauseum by Morningstars and others that there is no alpha in large cap, right? So it's very hard for large cap managers to pick stock to beat the benchmark because there's not a lot of edge in information. And so one of the most successful large cap strategies actually from my former firm, PIMCO, who was a fixed income manager. And what they do is they do a portable alpha strategy. So they get a passive exposure for S&P either through options or futures. And then they manage the collateral to generate alpha. And it has been shown that you can generate alpha through fixed income. So you're porting the alpha from fixed income assets into a passive S&P 500. What we do is a little bit different, is that we will get exposures through options and we can manage actually the capital gains of that passive exposure. But we do manage the collateral in tax advantage assets like municipals. So what you have is you get a yield advantage to S&P 500. Dividend rate for S&P 500 is very low right now, sub 2%. We're able to generate yield from municipal bonds. And of course, as you know, most distributions from municipal bonds are not taxed federally. So you have a tax advantage distribution from an S&P exposure. So you have exposures to S&P 500 and you have the collateral in municipal bonds. So we have quite a few interests there. So we're trying to collate and create that control group so we can launch and list this ETF. Here, I think the benefits I just want to quickly go over is that you do have exposures to two betas. So one is S&P 500 and the other is obviously Muni, which for many advisors, they have both betas. And what this does is actually makes it extremely capital efficient. So in one ETF, you have both betas. You can leave a portion of your portfolio in cash. So if market opportunity comes up, we had a big dip in Liberation Day, you have the two betas that you have already in your portfolio, but you also have cash that you can deploy for any opportunities that are in the market. You don't have an income growth trade-off. Here, oftentimes, if you're a dividend equity investor, you have to pick dividend stocks, right? Which is generally utilities, financials, energy companies, which are older part of the economy, and you have to underweight tech or other communications stocks, which is growth, right? So here, you get the full exposure of S&P 500. You don't have to distort any of the sectors. And you get income from municipals, which are actually tax advantaged income that you can have. And then we can manage the passive S&P 500 exposure, and we can manage the capital gains on that to reduce the capital gains on the passive S&P 500. So it's sort of a double tax efficiency. Again, going back to what our mission is to offer. This is the portable alpha strategy has been used in pension funds for, I would say now 25 years. So we bring that institutional strategy into an ETF format for taxable investors, and we make it as tax efficient as possible because those pension funds don't have to worry about taxes. And so just to quickly sum up, the three use cases that the advisors who are going to are very excited about is it can replace dividend equity because now you don't have to distort your sector to get income. You get the full exposure of the US market, and you get non-taxable income from the munis. You can also replace passive equity because now you have an exposure that can help you manage. You can generate alpha, right? The goal is to outperform S&P 500, not just to meet S&P 500. And that's actually just as an aside, when rates were very low, it makes sense to be in passive, right? Because the discount rate is low, valuation for every asset is going up, right? So you just ride the boat, right? But now we're in a different rate environment in which rates are higher. There's more idiosyncratic risk in the market, right? So you have seen more flows into active strategies, and that makes sense now because rates are high, cost of carry is high. Not every company can meet their borrowing costs. So there's going to be good companies who can outperform that, and there's bad companies that can't. And so there's more idiosyncratic risk in it. So active, be able to pick a bit more would help enhance returns. And the last thing is just this is a very capital efficient solution. The reason why portable alpha was designed for pension funds is that pension funds have to distribute liabilities. They don't want to be constantly adjusting their strategic asset allocation. So having two betas and having cash on the side, they can manage their cash distributions for the pensioners much more easily. So we're bringing that sort of institutional framework here into for everyone, accessible for everyone. We have a few different ETFs coming up. We have some cash ETFs that also could be used for 351, gold ETF, and then some oil, gas, and ETF that I think depending on how you manage your risk might be interesting in your portfolio. I want to just go over like what is the process. If you say 351 is something that I want to explore and I want to do, what does the exchange process actually look like, right? So this is our process. It could be different from other people. The first is obviously we talk to the client and kind of make sure the goals are aligned in terms of what they want to do in their portfolios. We identify an ETF that you want that fits in your portfolio, right? That's the key, is that you want your destination to be better than where you are now, right? So it's not just that for the fact of doing this. We want to have strategies that you're going to want to hold for a while so you can manage, the tax liability in the portfolio. We will ask about the sizing because that will help us to group people, together so that to make sure we can meet the control test. And we generally have a spreadsheet in which you would put in basically the securities you want to contribute with the basis. What that does is it helps us we do a double check to see if we meet the diversification test. We do a double check to make sure, we want to make sure every single exchange obviously is qualified. And then that security mapping actually, we take it, and if there's other group of people in the control group, we come together so that we know what assets are being contributed into the ETF, so we know how we can manage the incoming basket of ETFs. The second step is we often recommend that you get a tax opinion because these are pretty clear rules. So we want to make sure that tax lawyers have reviewed the basket and say, yes, this is correct. And then, this is a control test. It meets the control test and it meets the continuity test. And then we want to check the asset liability, right? So we make sure what assets in the basket can be contributed. And the technical term is any DTCC eligible securities can be done for 351. So that could be stocks, it could be bonds, it could be MLPs. So any securities that are DTCC eligible can be used in a transfer. And then last thing is the day before, the price in the stock prices might move. So you might, if you're just at 25%, it might move up to 25, 26%. The day before, we double check everything to make sure it still satisfies the test. Our custodian is US Bank. We give them the spreadsheet. That's why we have the spreadsheet. They use the spreadsheet to confirm the assets that are being transferred. Then the assets are in the ETF, and the shares of the ETF is deposited back to your custodian or broker dealer. And that's it. That's basically the whole transfer process. So if you're interested, please feel free to, to reach out. Our email is info@kurvinvest.com, which is, info, INFO at Kurv Invest, which is KURVINVEST.com. I think we got a few questions, Michael. I don't, should we address them?
Yeah, I see them right here. So, question, what do you mean having cash on the side? So you only invest part of the money in munis and S&P 500 options futures. How much cash do you hold back from the strategy?
Oh, yes. Sorry. Let me explain. The ETF itself has a S&P 500 passive exposure, and then the collateral to back that option or future is invested in munis. That's the ETF itself, right? The ETF gives you two betas. It gives you an S&P 500 beta and a municipal beta, right? So stepping away, your current portfolio, they have, let's say, 60% in SPY. They have 40% in bonds. Maybe 20% of that is in munis, right? So now instead, you can take 20% of munis out and then 20% of S&P 500 ETF out. Buy this ETF, you get both betas, and then you have 20% in cash in your portfolio, not in the ETF, in the portfolio. So it's cash efficient because now you have the same exposure. You have both exposure for S&P 500 and muni, and you have cash available in your portfolio. So if you need to, say your client needs some distribution, or you want to invest that if you see something distressed in the market, you have cash in your portfolio to deploy because the ETF has both exposures in your portfolio. There is also a second question.
Once the ETF is launched, is there a minimum holding period? And then that's three questions. Let's talk about that first.
Yeah, no. And that's actually the benefit relative to exchange funds. So once you have shares of the ETF, the quality of your gains remains. So if you have long-term gains, it's long-term gains, you can sell it the next day if you want, right? But you'll realize the gain. So oftentimes what people do is they hold the ETF, and then when they have losses somewhere else, they realize they crystallize the loss and they sell a little bit of the ETF. So that gains offsets the loss, right? So that's actually the benefits. Like the next day you receive the ETF shares, you have immediate liquidity. Versus exchange funds, you have up to 7 years of lockup.
There's another question. Why would someone use a 351 versus custom indexing?
Well, I guess it depends, right? Because 351 is a basket of securities it shows up in your account as one security. I know there's a lot of custom indexing. You put your money in another party, they do the indexing, and sometimes they can do tax loss harvesting or 130/30, right? But that still sit in a basket of different securities in a different account. Here, it's just, I guess it's a different wrapper. You have all the securities in one security. So if you want to sell, it's just you're selling one security instead of a basket of securities, right? So there's a bunch of other questions from the other.
Yeah. I was going to go. Each contributor will have a separate cost basis based on their contribution of stocks. Maybe clarify that.
That's right. So every contributor in the control group will fill out that spreadsheet. And what you get is when we get shares of the ETF, each contributor will have a different basis based upon how much capital gains they have in the spreadsheet. So it will be different for each contributor, but the whole group will pass the control test.
Any short-term gain will become a long-term gain after a 12-month holding period. The cost basis for long-term and short-term holdings will be different. How does that work?
That's right. And so just, I'll give you a corner case to illustrate the point. Let's say the day that you contribute your asset is that you've held that securities for 364 days, and then you get the ETF shares back. And now it's 365 days and you met that 1 year. So then your short-term, when you transferred it, is short-term capital gains, and when you receive the ETF, it's still short-term capital gains, but 1 day after, it becomes long-term capital gains. So you keep your holding period. You don't lose that holding period.
Yeah, that makes sense. Question about the duration of the benchmark when it comes to the munis. What type of duration?
So that's part of the active management. We are right now, we're from PIMCO, so we care about these things. I will say right now, the duration of the benchmark will be shorter. So it will be shorter around maybe 3 to 4 years, largely because the curve is still very flat in the front end. You can get 4.25, roughly 4 pretty well. And then the curve is a little bit inverted in the middle. And then there's a lot of volatility in the long end, right? So if we expect that we have another widening out in the long end and it reaches its peak, we could extend duration to get some of that spread compression, but that's an active decision. So we'll pair it up with, a short dated munis and also, potentially even higher high yield muni. We have the prospectus, so you can actually, it's already on Edgar. If you're interested, we can send it to you. Yeah.
And then last question here. Again, folks, if you want the CE credit, I will email you afterwards, just as a reminder, so stay tuned for that, for the CFP board. Stocks of private companies, are those allowed in the ETF as well? If allowed, need the investor to be the promoter of the private company? Any lower limit of ownership? I don't think you can do private companies, right? I mean, I guess up to...
No, because I don't think they're DTCC eligible.
Right, okay, that's right.
Yeah.
Yeah, but sounds... Okay, anything else we should hit maybe? I know you mentioned some of the other funds. Obviously, Kurv's got a number of interesting products coming, but you've got a number of interesting products right now as well.
Yeah, I mean, we have our Tech Titans ETF is going to reach a first year anniversary in 20 days. I know performance is important, and we've done really well relative to if you're investors, other dividend like ETF like JEPQ or things. I would take a look at it. Even SCHD, things like that. The premise is basically we are surrounded by innovation, and we should have exposure in our portfolio to innovation. But typically, growth companies do not distribute dividends. So we want to have an exposure in which you get growth and you have dividends. And maybe just a little bit of our positioning in the portfolio that might be of interest. We have always been pretty constructive on AI infrastructure, not the software layer, but infrastructure. We have sold it even through Liberation Day, DeepSeek, etc. And that has actually rebounded and has been an alpha generating portfolio. We are also anticipating that the economy will slow down going into second half of the year. Whether we go into a technical recession is a different question, but we definitely see a slowdown in the economy. So we tend to be in more of a consumer side of tech. So things that people will cut last in their budget, things like Spotify or Netflix. And then the last theme that we have in the theme is that we do believe robo-taxi is something that is here to stay. And we have exposures to Google, Waymo via Google, but that's not a pure exposure. The one place we actually think is a pretty good place is we want to find a stock that is cheap, meaning there could be earnings growth, and it's cheap in the sense of the PE is actually pretty low. So you have a double-decker expansion, multiple expansion plus earnings growth. That's pretty good. And so we have had Uber in the portfolio, and that has proven. We bought it before the recent rise, so that has been a contributor to the portfolio. And the last thing is we don't want to be exchange constrained. So oftentimes you buy a NASDAQ 100 ETF, you think that's mostly technology, but that's only stocks that are listed on a NASDAQ exchange, right? So we don't want to be constrained by an exchange. So we also look at companies that are not listed in NASDAQ. One name is for instance, Oracle, listed on a New York Stock Exchange. Even Spotify, for example, is the New York Stock Exchange and is a European company, right? So we want to be geographically, we don't care about which exchange they're listed and where it is, as long as it's driving innovation and it fits sort of the where we are in the economic cycle. So if you're interested, we're always happy to talk to you guys about the strategy.
Appreciate everybody that attended here. Everybody, make sure you learn more about Kurv on their website. Hopefully you found this educational, and obviously reach out to Howard if you have questions or want to get more directly engaged. info@kurvinvest.com. I am now going to get some other work done, as I'm sure Howard will as well as many of you find people on this webinar on a working vacation. But I appreciate those that joined here on a relatively slow day, but not a slow webinar. Thank you, Howard. Appreciate it.
Thank you, everyone. Thanks, Michael.
Cheers, everybody.